Why aren't your investments topping the S&P 500? Welcome to the program You Can Surpass the Stock Market. Here I show you how you can reach the peak where few arrive in the stock market. I am Francisco and I'm an expert in finding stocks that can top the S&P 500. Today we're going to dig into the common mistakes people make to top the S&P 500, and then I'll reveal the right way to finally get ahead. Stick around because this could change the way you invest forever. Let's start by breaking down what it means to top the S&P 500. The S&P 500 is a stock market index that tracks the 500 largest companies listed on US exchanges. It's often used as a benchmark for overall market performance. If your investments are topping the S&P 500, it means you're getting a better return than this group of companies on average. Sounds simple, right? But in practice, it's far from it. Now, here's where things get tricky. It's not just about picking a few winning stocks. Topping the S&P 500 requires consistent performance over time, not just one lucky trade. And it's here that most investors hit a wall, which is what many people do. First, topping the S&P 500 is not just about avoiding losses. You might not lose money, but that doesn't mean you're outpacing the market. Plenty of investments may keep your principal safe, but they won't necessarily grow it beyond what a simple index fund could. Second, it's not the same as having consistent returns. You could have steady returns year after year that are still below the average performance of the S&P 500. It's the difference between stability and maximizing growth potential. And finally, it's not synonymous with high-risk trading. Sure, you could take big risks and occasionally hit big wins, but that's not the same as consistently topping the S&P 500 over the long haul. Big risks can also mean big losses. 90% of investors are failing. Here's the secret strategy to turn things around and leave them all behind. Don't top the stock market. Only about 10% do over the long term. Learning the right skills and strategies puts you at the peak, where few arrive, setting you apart from the crowd. Imagine leaving behind the vision of underperforming, the sense of always being one step behind, missing your financial goals. The benefit? More money in your pocket, more freedom, more options, more security. Picture this: investing $100,000 with an average market return of 7% annually. You'd have about $386,968 in 20 years. But if you outperform by just 3% and achieve a 10% return, you'd end up with $672,750, nearly double. How? Understand market fundamentals and use stock screeners to automate investment choices, saving time and boosting strategy. You need to understand market fundamentals, analyze stocks properly, and stay ahead of trends. Utilize stock screeners to automate the process of identifying potential investments, because they can filter thousands of stocks based on criteria you set, like growth rates, dividend yields, or P/E ratios, allowing you to quickly find stocks that match your strategy without spending hours on research. You can even automate these screeners to send alerts or updates, so you stay informed without lifting a finger. Think outshining the S&P 500 is too complicated? Here's how you can do it without wasting hours. You might think that outshining the S&P 500 is too complicated and time-consuming, requiring constant monitoring of the market and in-depth analysis. This feeling of overwhelm could lead you to avoid taking action, missing out on the potential to grow your investments beyond average market returns. The reality is that outshining the stock market doesn't have to be a full-time job. By learning a few key strategies and using smart tools designed for busy professionals, you can create a hands-off investment approach that doesn't require constant attention. With these efficient strategies in place, you can achieve market-beating returns while saving time and effort, freeing you up to focus on other priorities without sacrificing your financial goals. Don't you believe it's possible to consistently top in the stock market? I'll prove you wrong. You may think that consistently topping the market is impossible, believing it's a feat only for Wall Street insiders or purely a matter of luck. This skepticism might prevent you from even trying, causing you to settle for average returns and miss the opportunity to significantly grow your wealth. While it's true that many investors fail to top the market, some consistently do so by following disciplined, proven strategies. Learning these methods, backed by data and experience, gives you a real shot at outperforming the average investor. Adopting a proven smart strategy allows you to challenge the norm, potentially achieving superior returns and putting yourself among the top performing investors, regardless of your starting point. No big money? No problem. How to outsmart the S&P 500 without risking it all? You might feel that trying to outsmart the S&P 500 requires a large amount of money or taking on significant risk, which feels too dangerous for your current financial situation. This fear of losing money can keep you from investing altogether or lead you to stick with the safer, low-return options that don't help you reach your long-term goals. Outsmarting the S&P 500 doesn't mean taking on reckless risks or needing a large capital. It's about making smart, calculated decisions that align with your financial situation and risk tolerance. Even small strategic improvements in your investment approach can yield significant gains over time. By understanding that you can start with whatever amount you have and make informed choices, you can grow your wealth steadily without taking on unnecessary risk, giving you greater financial confidence and security. Let's start with the wrong ways to break ahead of the S&P 500. Believe it or not, many investors are trapped in these pitfalls, thinking they're on the right track when they're actually sabotaging their own success. One of the biggest mistakes many investors make is chasing hot stocks. We've all seen it happen. There's a buzz in the air. Everyone's talking about a new trendy stock that seems like a surefire win. It could be a meme stock that's gone viral on social media, like GameStop or AMC, or a company that's made headlines with a big announcement like Tesla after unveiling a new innovation. The temptation is strong, and it feels like everyone around you is jumping on the bandwagon. So you rush to buy, thinking you're about to make a quick profit. But here's the reality. By the time you hear about it, the stock has often already peaked. You're buying at a price that's been inflated by all the excitement and hype. When the frenzy dies down, and it almost always does, you're left holding a stock that's rapidly losing value. It's like arriving at a party just as everyone else is leaving. You think you're in on a great secret, but in truth, you're too late to the game. The pros who got in early have already cashed out with their profits, while you're stuck with an overpriced stock that's plummeting. Consider the example of GameStop in early 2021. The stock skyrocketed from around $20 to nearly $500 within weeks due to a viral social media campaign. Many retail investors, hearing the hype, jumped in at the height of the frenzy, believing they were going to ride the wave to wealth. However, as soon as the buzz started to fade, the stock price tumbled, and many of these latecomers suffered significant losses. It wasn't a strategy based on logic or solid fundamentals. It was driven purely by emotion and the fear of missing out. This kind of behavior is not investing. It's akin to gambling, where you're putting your money on a risky bet without a real understanding of what you're buying into. Chasing hot stocks is like buying lottery tickets. It might pay off once in a blue moon, but the odds are heavily stacked against you in the long run. And when things go south, the cost can be high both financially and emotionally. So, what's the right way to break ahead of the market? The answer lies in focusing on long-term, value-driven investments. This approach is about finding companies with strong fundamentals, those with solid balance sheets, consistent and sustainable earnings growth, and competitive advantages that set them apart in their industries. You're looking for stocks that are undervalued compared to their intrinsic worth, meaning they're priced lower than their true potential. Let's draw an analogy. Imagine you're at a farmer's market and you see a stall selling perfectly ripe, delicious-looking apples at a discount because they're slightly bruised. Everyone else is flocking to the shiny new, high-priced produce, but you recognize that these slightly bruised apples are still fresh, tasty, and nutritious. You buy them at a lower price, knowing they'll provide the same, if not more, value. This is what value investing is like, finding hidden gems that the crowd has overlooked. Take the example of Warren Buffett, one of the most successful investors of all time. Buffett's strategy revolves around identifying high-quality companies and holding on to them for the long haul. He famously invested in companies like Coca-Cola, American Express, and Apple, not because they were hot stocks at the moment, but because he believed in their long-term potential and competitive advantages. Buffett wasn't interested in quick profits. He was interested in steady, sustainable growth over decades. By focusing on long-term, value-driven investments, you're letting time work in your favor instead of trying to time the market or predict short-term price movements. You're betting on the long-term success of solid businesses. This approach minimizes risk by avoiding the emotional ups and downs of the market and maximizes the power of compounding returns. For instance, consider the example of investing in Johnson & Johnson, a company with a long history of steady growth and strong fundamentals. Even during market downturns, Johnson & Johnson has demonstrated resilience due to its diversified product lines and consistent demand in the healthcare sector. An investor who bought Johnson & Johnson stock years ago and held onto it in the short-term noise would have seen substantial growth and regular dividends over time. This is the power of focusing on value and long-term potential rather than chasing after what's hot in the moment. One of the biggest mistakes many investors make is over-relying on high-risk, high-reward strategies. The allure is undeniable. Placing all your money into a single speculative stock with the potential to shoot to the moon can feel like a shortcut to wealth. The thrill of a massive payoff from a single bold bet is enticing, but the harsh reality is that this approach is more akin to gambling than it is to sound investing. While you might occasionally get lucky and score a significant win, the odds are far more likely to lead you to significant losses. When your strategy is built on luck instead of sound financial principles, you're essentially playing a game with bad odds. The stock market is naturally volatile, and speculative stocks amplify this risk even further. You could see dramatic price swings that wipe out your gains and more, especially if you aren't prepared to handle these fluctuations. Consider the real-life example of the dot-com bubble in the late 1990s and early 2000s. During this period, technology stocks were hot investments everyone wanted to own. Investors poured money into internet companies with little or no earnings, driven by the hype that these companies would be the future of business. Stocks like Pets.com, Webvan, and many others skyrocketed based on sheer speculation. Investors who jumped in late, hoping to ride the wave, were in for a rude awakening. When the bubble burst in early 2000, many of these stocks lost 80% to 100% of their value almost overnight. For instance, Pets.com, which had gone public at $11 per share, collapsed to mere pennies within a year, leaving investors with devastating losses. Those who over-relied on these high-risk, high-reward strategies found themselves with almost nothing. The problem? They invested in hype, not in companies with sound financial fundamentals. To avoid this trap, consider adopting a strategy known as dollar cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. It's a straightforward yet effective method that removes emotion from investing and fosters discipline. Think of dollar cost averaging like growing a garden. Instead of planting all your seeds in one go and hoping for the perfect weather, you plant a few seeds every week. Some weeks are stormy, some are sunny, but overall, your garden grows steadily. You're not trying to predict the perfect day for planting. You're nurturing consistent growth over time. The same principle applies to investing. Instead of trying to time the market or placing all your bets on one speculative stock, you consistently invest in a diversified portfolio over time. This method reduces the risk of making a substantial investment right before a market downturn, and it helps lower your average cost per share, smoothing out the market's volatility. To illustrate how this strategy can work, let's look at a real-world example. Warren Buffett's investments in Coca-Cola. In 1988, Buffett began buying shares of Coca-Cola, a well-established company with a proven business model, strong brand, and consistent earnings. At the time, many thought he was paying a premium price for the stock, but Buffett wasn't concerned with short-term price movements. Instead, he applied a value-driven long-term investment strategy, gradually accumulating shares over time. By regularly purchasing shares of Coca-Cola, Buffett utilized a form of dollar-cost averaging. He wasn't trying to time the perfect entry or exit point. He was confident in the company's long-term fundamentals. Over the decades, as Coca-Cola continued to grow and generate steady returns, the value of Buffett's investment soared. What started as a $1 billion investment is now worth over $25 billion, not including the substantial dividends Berkshire Hathaway has received over the years. Now, to take this a step further, consider combining dollar cost averaging with value investing. Instead of just spreading your investments across the market at regular intervals, focus on investing in undervalued, high-quality stocks. Value investing means looking for companies with solid fundamentals that the market has overlooked or undervalued, like finding a diamond in the rough. Let's consider Johnson & Johnson, J&J, as a prime example of a strong value-driven investment strategy, especially when compared to the broader market, like the S&P 500 index. In the aftermath of the 2008 financial crisis, J&J presented itself as a company with a robust balance sheet, diversified product lines across pharmaceuticals, consumer goods, and medical devices, and a proven history of steady growth. Despite market turmoil, J&J was viewed by many as undervalued due to temporary fear and uncertainty. If an investor had begun investing $1,000 each month in Johnson & Johnson shares, starting in early 2009, they would have been purchasing shares at a time when the stock price was significantly depressed. At the beginning of 2009, J&J's stock was trading around $54 per share. Over the following decade, J&J's stock price steadily climbed, reaching over $150 per share by the end of 2019. This represents an approximate threefold increase in value, even without considering dividends. Now, let's compare this performance with the S&P 500 index over the same period. At the start of 2009, the S&P 500 was valued around 900 points. By the end of 2019, the S&P 500 had risen to approximately 3,200 points, which is also roughly a threefold increase. However, the S&P 500 is a broad market index composed of 500 large-cap U.S. companies, providing diversified exposure but also containing many stocks that may not perform as well as others. J&J, on the other hand, offered consistent returns driven by its strong fundamentals, stable revenue streams, and reliable dividend payouts. During this period, Johnson & Johnson's dividend yield was generally higher than the average yield of the S&P 500. For example, while the S&P 500's dividend yield hovered around 2 to 2.5%, J&J consistently offered a yield closer to 3%. Additionally, J&J has a long history of increasing its dividends annually for over 60 years, which further enhanced total returns through dividend reinvestment. For an investor who adopted a dollar-cost averaging strategy, investing $1,000 per month in J&J shares would have benefited from purchasing more shares during market dips, thereby lowering the average cost per share over time. This approach would have maximized the gains as the stock rebounded and grew, allowing the investor to compound returns through both capital appreciation and reinvested dividends. J and the S&P 500 provided strong returns over the decade following the 2008 financial crisis. J&J's stability, consistent dividend growth, and strong fundamentals made it an attractive choice for value-driven investors looking to outperform the broader market. The combination of steady share price growth, higher dividend yields, and a disciplined investment strategy could lead to significant long-term gains, demonstrating the potential benefits of focusing on high-quality, value-driven stocks compared to a broad market index. This combined approach works because it leverages the power of consistency, and strategic thinking. Dollar-cost averaging ensures you remain disciplined, continually investing without letting emotions dictate your decisions. Meanwhile, value investing ensures you're targeting stocks with strong fundamentals and long-term growth potential, reducing the risk of loss from speculative investments. By regularly investing in undervalued companies, you create a balanced approach that capitalizes on market opportunities without exposing yourself to extreme risks of high-stakes gambles. This method mitigates the impact of a short-term market volatility and allows you to build wealth steadily over time. Day trading is often seen as a quick path to riches, with many believing they can outsmart the market by making rapid-fire buying and selling decisions to capitalize on small price movements. The thrill of potentially making money in minutes or hours can be incredibly tempting. It's portrayed in movies, books, and social media as a glamorous and high-stakes game where fortunes can be made overnight. But here's the reality. Day trading is extremely difficult, even for seasoned professionals. Successful day trading requires more than just the basic knowledge of the stock market. It demands an exceptional ability to make split-second decisions under pressure, a deep understanding of technical analysis, access to sophisticated tools, and importantly, a very high tolerance for risk. Most people who attempt day trading quickly discover that they're not only competing against other retail investors, but also against institutional investors. Large financial firms equipped with advanced algorithms, high-frequency trading systems, and vast amounts of data. The playing field is anything but level. Even professional traders who have the benefit of experience, resources, and technology often struggle to consistently beat the market. Research shows that a significant majority of day traders lose money over time. In fact, one study found that only about 1% of day traders are consistently profitable over the long term. For most, the potential gains are quickly eroded by transaction fees, taxes, and poor decisions made in the heat of the moment. This scenario is not uncommon. Day trading is akin to gambling in a casino, where the odds are stacked against you. The adrenaline rush may be exciting, but the probability of consistent success is low. For most people, day trading leads to losses, frustration, and regret. Instead of getting caught up in the high-risk game of the day trading, consider a more reliable approach: strategic diversification. Diversification is a proven strategy that involves spreading your investments across different sectors, industries, and asset classes to reduce risk. Think of it like a balanced diet for your portfolio. Just as a healthy diet includes a variety of foods to ensure you get all the necessary nutrients, a diversified portfolio contains a mix of investments to provide stability and growth potential. But it's important to note that diversification doesn't mean buying dozens of random stocks. Effective diversification requires building a balanced portfolio that reflects your risk tolerance, time horizon, and financial goals. The idea is to create a mix of assets that do not all move in the same direction at the same time. This way, if one part of your portfolio underperforms, other parts can help offset those losses. For example, imagine your portfolio consists of stocks in technology, healthcare, and consumer goods, along with some bonds and real estate. If the tech sector experiences a downturn, the losses may be balanced by gains in the more stable healthcare sector or the fixed income from bonds. Let's explore a real-world example of strategic diversification using stocks during the dot-com bubble of the late 1990s and the early 2000s. During this period, technology and internet stocks experienced a meteoric rise. Investors were pouring money into any company with a .com in its name, driving stock prices to irrational highs. However, when the bubble burst in early 2000, many tech-heavy portfolios suffered dramatic losses as these overvalued stocks collapsed. The Nasdaq Composite, which was heavily weighted with technology stocks, fell nearly 78% from its peak in March 2000 to its low in October 2002. But not all investors fared poorly during this period. Those who employed strategic diversification within their stock portfolios managed to navigate the crisis more effectively. Investors who diversified their stock portfolios by balancing high-growth tech stocks with more stable, value-oriented stocks in sectors like consumer goods, healthcare, and utilities were better positioned when the bubble burst. While tech stocks plummeted, companies like Procter & Gamble, Johnson & Johnson, and Coca-Cola continued to perform relatively well. These companies had strong fundamentals, consistent earnings, and were less affected by the speculative frenzy surrounding tech stocks. For example, while a tech-heavy portfolio might have been down 70% or more, a diversified portfolio containing both tech stocks and defensive stocks like Johnson & Johnson or Procter & Gamble would have experienced significantly less damage, preserving capital and providing stability during the downturn. Another key component of diversification was the inclusion of dividend-paying stocks. Many technology stocks during the dot-com era did not pay dividends. They were high-growth companies reinvesting earnings back into the business. On the other hand, traditional blue-chip companies like AT&T and Pfizer continued to pay regular dividends even as the market declined. These dividends provided a steady income stream, which could be reinvested to buy more shares at lower prices, effectively lowering the average cost per share and cushioning overall portfolio losses. Diversifying across sectors was another strategy that helped mitigate losses. While the technology sector was hit hardest, other sectors like energy, financials, and industrials experienced less dramatic declines or even saw gains in some cases. An investor who diversified across multiple sectors, holding stocks in energy companies like ExxonMobil or Chevron, saw some balance in their portfolio. These stocks often moved independently of tech stocks, providing a counterbalance when the tech sector collapsed. Investors who diversified between small cap and large cap stocks also found that this approach reduced volatility. Small cap stocks, particularly those outside the tech sector, often performed differently than large cap tech stocks. By maintaining exposure to both small cap and large cap stocks across various sectors, investors could mitigate the risk associated with any single market segment. Moreover, diversification benefits from the principle of correlation. Different assets often react differently to the same economic event. For example, during periods of high inflation, commodities like gold might increase in value, while stocks could decline. By holding both in your portfolio, you mitigate potential losses. While day trading might sound exciting, it's a high-risk strategy that rarely leads to consistent success. Instead of trying to time the market with rapid trades, consider a more strategic approach by diversifying your portfolio. Spread your investments across different sectors, industries, and asset classes to build a balanced portfolio that can weather market volatility and grow over time. Diversification may not be as thrilling as day trading, but it's far more likely to help you achieve your financial goals. Remember, successful investing isn't about making quick, risky bets. It's about making smart, steady choices that build wealth over the long term. Stay diversified, stay patient, and let your investments grow. One of the most common mistakes that many investors make is overcomplicating their investment strategy. They believe that the secret to beating the market lies in analyzing every possible piece of information: macro trends, micro trends, technical charts, news feeds, economic reports, company earnings, and more. They assume that if they can just gather enough data, they will have an edge. But in reality, this often leads to what's known as analysis paralysis, where an investor is so overwhelmed by information that they can't make clear, decisive moves. Think of it like trying to cook a meal by looking at a dozen different recipes at once. You spend so much time reading, comparing, and debating that you never actually get around to cooking anything. The same thing happens with investing when you are drawing in data, constantly second-guessing your decisions and feeling stuck in a loop of overthinking. In the end, this can lead to missed opportunities and, ironically, worse investment outcomes. Imagine yourself as a diligent professional eager to grow your savings in the stock market. You're excited to make the most of your investments, so you dive in the head first. You subscribe to multiple financial newsletters, follow a dozen market analysts on social media, and start tracking countless sources of information: global macroeconomic trends, company earnings reports, technical charts, and more. At first, you feel empowered by all the information at your fingertips. You think you're on the right path, gathering every possible piece of data to make the best investment decisions. But soon, you find yourself drowning in information. One analyst is predicting a market rally, while another is warning of an imminent crash. One set of charts signals it's time to buy, while another suggests it's better to sell. You start to feel overwhelmed, spending hours every day reading market commentary, studying graphs, and trying to make sense of conflicting opinions. The more you read, the more confused you become. You second-guess every decision, afraid to make a move because there's always another article to read or another data point to consider. You begin to suffer from what's known as analysis paralysis. You're so bogged down by information that you can't make clear, decisive moves. Days turn into weeks and weeks into months, and you realize you haven't made any significant investments because you're constantly debating the best course of action. Opportunities pass by as you wait for the perfect movement, one that never seems to come. Your experience highlights a common problem. While you think you're making progress by gathering all this information, you're actually stuck. The excess of data is clouding your judgment and preventing you from taking timely action. You realize that more information isn't always better. In fact, it's often about knowing which data truly matters and filtering out the noise. Instead of getting lost in the endless flow of market data, you decide to simplify your investment approach by using a stock screener. You know that your time is valuable, and you need a more efficient way to identify opportunities without getting overwhelmed by information. By integrating a stock screener into your strategy, you find that you can make more informed decisions without drowning in data. We're no longer glued to financial news and charts, trying to process every market fluctuation. Instead, you've set specific criteria and let the stock screener do the heavy lifting, delivering these insights that matter most to your investment strategy. Your portfolio starts to perform better, not because you're monitoring every piece of market information, but because you're making strategic choices based on key metrics that align with your goals. You're moved from analysis paralysis to decisive action, freeing up your time to focus on other important aspects of your life. Think of using a stock screener like being a skilled chef. A great chef doesn't need every spice in the pantry or to try every recipe to create a delicious meal. Instead, they focus on a few high-quality ingredients and master the essential techniques to achieve the best results. Similarly, in investing, you don't need to analyze every bit of data available. By focusing on essential metrics through a stock screener, you streamline your process and make effective decisions. One common pitfall many investors fall into is overtrading, constantly tinkering with their portfolios, buying, selling, and rebalancing almost every week. They believe that being in perpetual motion is the key to staying ahead of the market. They feel they need to react to every bit of news, every market fluctuation, and every new economic report. However, this constant activity can backfire, racking up fees, taxes, and emotional stress. Instead of boosting returns, it often eats away at them. Think of overtrading like trying to drive a car by constantly slamming on the brakes and hitting the gas. Not only does it burn more fuel, but it also puts unnecessary wear and tear on the vehicle. Similarly, when you're constantly trading, you're burning through your capital with transaction costs, taxes, and potentially poor timing. Imagine yourself as an enthusiastic investor, convinced that frequent trading is the key to beating the market. You start each day by scanning financial news websites, closely watching market tickers, and keeping up with the latest reports. Whenever you hear about a company's strong quarterly earnings, you jump in and buy the stock. If you read a negative analyst report, you quickly sell off your holdings. And when the market takes a dip, panic sets in, and you sell your stocks only to buy them back again when prices seem to stabilize. At first, this feels exciting. You feel like you're actively managing your investments, staying engaged, and making moves to stay ahead of the market. The thrill of making quick decisions gives you a sense of control and involvement in your financial future. But over time, something starts to bother you. Your account balance isn't growing the way you had hoped. You decide to take a closer look and realize that constant buying and selling have racked up significant transaction fees and taxes. Every time you make a trade, there are costs involved that slowly chip away at your returns. Even more frustrating, you find that you often sell in a panic when the market dips and buy back in at higher prices when things start to stabilize. Instead of following the basic buy low, sell high strategy, you're inadvertently doing the opposite. By the end of the year, your returns are much lower than they would have been if you had simply held on to your investments. And it's not just your financial balance that's affected. The constant stress of monitoring your portfolio, making quick decisions, and reacting to every market movement has taken a toll on you emotionally. You find yourself worrying about your investments all the time, losing sleep over every market dip, and second-guessing every decision you make. You realize that your approach, far from being effective, has actually been counterproductive. The excitement you felt initially has turned into frustration and exhaustion, and you're left wondering if there's a better way to manage your investments. Instead of overtrading, the smarter approach is to stay informed about market trends and economic factors, but learn to filter out the noise. Not every headline or market movement requires a reaction. Trying to time the market or making frequent, quick adjustments usually leads to mistakes that cost you money in the long run. Think of investing like sailing a boat. You need to keep an eye on the weather and adjust your sails as needed. But if you're constantly changing direction with every gust of wind, you'll never make it to your destination. The key is to maintain a steady course, making adjustments only when necessary based on significant long-term changes. To avoid the temptation to overtrade, consider adopting a core and satellite investment strategy. This strategy involves building a core portfolio of stable, diversified investments that represent the foundation of your investment strategy. The core is designed to provide steady, long-term growth and requires minimal management. Around this core, you create a satellite portion of your portfolio with a few carefully chosen investments that you believe have the potential for higher returns. These might be specific stocks, sector funds, or alternative assets. The satellite portion is a smaller part of your portfolio, allowing you to make more focused bets on opportunities without jeopardizing your overall strategy. If your core portfolio consists of 80% in stable, blue-chip stocks like Apple, Johnson & Johnson, and Coca-Cola, companies with strong fundamentals and history of steady performance, the remaining 20% can be allocated to satellite investments. You might choose a few high-growth tech stocks like Nvidia or Tesla, or stocks in emerging sectors such as biotechnology or renewable energy companies like Enphase Energy. This way, you get to satisfy the desire for active management and capitalize on potential growth opportunities without overtrading or deviating significantly from your long-term goals. The core and satellite strategy works because it allows you to stay focused on your long-term goals while satisfying the urge to actively manage part of your portfolio. The core portion remains stable, providing a solid foundation that minimizes risk, while the satellite portion gives you the flexibility to explore opportunities and take advantage of market movements without the risk of overtrading. By combining a stable core with targeted satellite investments, you maintain a balanced approach. You're not reacting to every piece of news or market shift, but you're still actively engaged and strategically positioned for growth. This method reduces fees, taxes, and emotional stress, helping you stay aligned with your long-term strategy and achieve better overall results. If you want to learn more about identifying stocks with the potential to outperform the S&P 500, make sure to follow me. Click now to get my tips, analysis, and investment strategies. Let's learn how to invest smarter and achieve better market results together. Click to follow and stay updated.